Welcome back, guys. Lex here, and because I get this question quite a lot, I thought I would start a series on it, and that is exactly how do you get into investing, step by step, video by video. I imagine this will be a few videos long. I'm not sure how many, but let's get into it and we'll see. Now, in order for you to create your own ideal portfolio and to start investing, from my point of view, you need to understand two things very well. Number one, you need to understand some basics about the markets, about the terminology, about the theory of investing. And number two, you need to understand yourself, your own goals, what your risk tolerance is, what you want to do with that money, how much you need, etc. So there are two components. Number one is external knowledge of the market, so the theory of how investing actually works. And number two is understanding yourself. How much money do you need? Where do you plan on using it? How exactly are you going to use it? How much risk can you take? And all of these things that are completely up to you to determine. Now, I want to be absolutely clear. Investing is a habit, so you need to build it just as much as, for example, you build habits of going to the gym or eating healthy or doing something good for yourself. That takes time, that takes practice, so you need to commit to building that habit. It's not something that you will actually do just once and forget about it. You will for sure need to, well, of course, invest monthly or invest on regular periods, as well as monitor your portfolio and make adjustments where necessary. So it is a habit and it takes time to build, but if you build it as early as possible, you would be very grateful to your current self in the future. So in this video, we'll be talking about the basics of investing, so the fundamentals that you need to understand before you even consider going into the market. And in the second video, we will cover the things that you need to understand about yourself, about how you're going to plan, about how you're going to invest, about your budget, etc. So video number one, which is this one, it's about market and investment theory, knowledge, and understanding. And in the second video, we will be talking about what you need to sit down and think about for yourself in order to actually start yourself on this journey. Okay, let's get into it. Okay, guys, so the first thing that we need to understand about investing is the difference between investing and trading. Because when a lot of people hear investing in the stock market, they are actually thinking about trading. Now, when you're trading, you are actually speculating on the short to mid-term value of a certain asset, which is a stock, for example. So your time frame is much shorter and the tools that you use are much different to evaluating whether you buy the stock or not when compared to investing. Because when we invest, we are buying an asset for the long term. We are buying something that we believe in. For example, that could be Google stock, Apple stock, whatever. It is a company that we've analyzed is suitable for us and we are planning to hold that for 20 years, 10 years, however long. So that is a long-term mindset rather than trading is something that you do to basically speculate on the markets with the aim of making a big profit as quickly as possible. That is a completely different mindset than investing. So again, we are not talking about gambling or speculation or any of the risky behavior that traders are known to participate in. We are talking about investing your own money for the long term and not using any leverage, which is a loan, for example, which traders might use, but investors typically do not. So with investing, it is a much safer approach and you are very, very, very unlikely to lose your money compared to if you just speculate on certain positions and you're trading and you're doing something that you do not understand or you do not have the knowledge or the technical skills to do. So investing is much safer. Okay, let's take a look at another thing. What is the difference between saving and investing? I've got here a really interesting article by Schwab, which is one of the leading brokerages for accessing the stock markets. And they have put together this article, which I will link in the description. You can check it out yourself. It's about the differences between how saving grows your money over time versus how investing does it. Now, what most people think about with saving is that you basically have some money in your bank account that you put in, say, whatever the amount is, like $1,000 every month or whatever. And then you have, say, 1 or 2% interest, which the bank pays you on the amount that you put in. That would be the basic and traditional way of saving your money for retirement or for buying a car or for buying a house, whatever it is. You just put it aside in a bank account and it earns a little bit of interest. That is what most people understand when we mean saving. Now, investing takes a similar approach, but with investing, we want to grow our money more than 1 or 2% per year. Typically, you would assume a bit more risk by investing your money, but you would also get a lot more reward. So instead of getting 1 or 2% per year, you would actually be getting, let's say, 5 to 10% per year, depending on how risky assets you are buying. So let's look at the examples here. These are two very similar people, Diego and Alexis, which invested for 20 years, so from 2000 to 2020, and they put in $3,000 each year in a bank account or in an investment fund, for example. Diego averaged 1% of return over 20 years, which is what the bank paid him in his deposit, which is, of course, very low. But his money was, in his view, safe and accessible, so that's what he did. So Diego had $67,000 after 20 years. Over that same period, Alexis did something different, which is she invested. So she did the same amount, $3,000 per year, in a moderate portfolio, which returned 6% over 20 years. Now, 6% is a relatively conservative portfolio. On average, the market returns 6 to 7%, so that's kind of the average that we usually look at when we talk about examples like this. And after 20 years, she had $140,000. So more than double what Diego had, just simply because she took a bit more risk and invested her money instead of just putting it in the bank. So when we talk about the risks of investing versus keeping your money in the bank, there is something very important that you need to understand, and that is the longer you keep your money in the market, so the longer they are invested, the lesser the chance that you will actually come out of that period with losses. So this is just market theory, and if you want to look more into statistically how the markets have worked through the years, why investing long term is the best strategy, and how if you invest for 20 plus years, you are pretty much guaranteed that there is no way that you will be at a loss compared to how you started. Now, if you want to get more into that, I recommend a book called The Little Book of Common Sense Investing, which is by John C. Bogle. This is basically the guy who invented the index fund. And he goes really into depth about why you should keep your investing very simple, why you should avoid costs as much as possible because it brings a drag on your gains, especially when you compound year by year, which is how the markets work, why you should be diversified, and the risks of picking individual stocks. So this is basically a very, very, very good book for investors, for beginner investors, and especially those looking to build a more passive strategy and just buy index funds and be done with it. But anyway, back to our saving versus investing topic. Here we have an example of inflation, how that eats away at our portfolios. Because even though we saw Diego had made some money after 20 years, inflation in that period has probably cost him a huge amount of his purchasing power during that period. We can see here how a pension of $50,000 in a hypothetical 3% inflation rate, now we have much more, you can imagine, can only purchase about $37,200 worth of goods at the end of a 10-year period. So essentially, after 10 years with 3% inflation, you have lost 26% of your purchasing power. And at the end of 20 years, you have lost 45% of your purchasing power. So you can see how just saving your nominal amount of, say, $50,000, you put in $3,000 every year in your bank account until you reach, for example, 50,000. That is the nominal amount of money that you have in your bank account, but due to inflation, that money is worth less and can buy you less things. At the end of 10 years, it can buy you 26% less things. And at the end of 20 years, it can buy you 45% less things, even though it is the exact same amount in your bank account. It has not depleted, it has not gone down, it has not been spent. It is the exact same $50,000, but due to inflation, it can afford you a lot less things because things are now more expensive after that period of time. So you can see how it makes much more sense for you to be investing than just saving, because inflation eats away at your money and you're basically going downhill rather than uphill. So we need to find a way to beat inflation in order to be actually making money on our savings instead of slowly losing them due to the strong force of inflation. And you might be wondering, okay, but it's only 3% inflation. How did I lose 45% in 20 years? That, my friends, is the power of compound interest, and that force can work against you as it is in the case of inflation, but it can also work for you if you invest, because as you can see here, pretty well visualized, that compounding a little goes a very, very long way. So for example, we have Alexis, who is the person who invests in the stock market rather than just saving, and if she invests for 40 years at $3,000 a year and 6% return, at the end of those 40 years, her portfolio is worth almost $500,000. And that consists of $372,000 in total earnings, while her principal, so that is the amount that she actually put in her investments, is only $120,000. So if you multiply 3,000 by 40 years, you get $120,000 is the money that she put in. The rest, $372,000, is the money that her money earned her. So that is the compound return on her investment. So you can see here, if you just put aside money, you would have $120,000, out of which inflation would have absolutely destroyed the purchasing power of that money. However, if you had invested and you took advantage of compound interest, you would have had, well, let's say almost 4 times as much money as just saving it. So that is the importance of having your money work for you and your money earning money for you. That is what rich people understand, is that you need to be making money while you sleep. And this is just one of the concepts that people like that are using in order to make money passively, or to leverage their savings to make more money. And another example is, when should I start investing? As soon as possible, because as you will see in this example, early beats often, because it is more important to have more periods of compounding, so more years, rather than invest larger sums regularly. Let's see. Examples again. Alma and Dave. Alma invests $10,000 when she's 31 and lets it grow for 20 years. Dave invests $2,000 a year on the same day each year, starting at age 41. So Dave started a lot later. And by the time they both reach age 50, Alma has 15% more than Dave, even though she invested half as much. So Alma has an ending balance of $32,000. Dave has $27,000 at the end of their investment period. So that's what she did. Alma just invested $10,000 and didn't add anything, just let that stay and grow. While Dave invested, how much is that? Dave invested for 10 years and $2,000 a year. So he invested $20,000. He invested more than her, but at age 50, he had less than her, even though he invested double the amount. But he had less time for that amount to actually compound. Alma invested less but earlier, while Dave invested more but later, and they all ended up with the same amount at 50 years of age. So you need to understand why starting now, starting as early as possible, gives you the best chance and the most compound returns that you can use, at your retirement or at your endpoint where you plan to actually start using that money. I do recommend that you come onto this website and you play around with this calculator just to see how much money you could be earning. So let's say you put in $10,000 now, and your interest rate is the market average, say 7% per year, and you plan to invest for 20 years. And you are also depositing, let's say, $500 per month, just to kind of keep adding to your investment. And when we calculate this, you will be ending up with $300,000 in your future investment value, while your basically your principal is $130,000. So you basically would have earned $170,000 at your retirement period or whatever. Let's say you started early. Let's say you started at when you were 20 and you're going to use that money when you're 50, and your investment horizon is 30 years and you're doing the exact same thing. You will end up with $700,000 nearly. So $500,000 of interest. So you can see the longer the period that compounds, the more your earnings will be. Let's say we take 35 years. So just 5 years more. How much is that going to yield us? 5 years more yields 1 million. So in 5 years, you made $400,000. That is something that took you nearly 20 years to make previously. Now you're making it in 5 years just because of the power of compound interest. So you can see the earlier you start, the better it is. No matter how much you're investing, it's better to start early with a little and to invest over a longer period, say 30, 40 years, than to start late but try to catch up. Just start when you're 40 and you put in a lot of money, but your period of compounding is very low. So yeah, just go on this website, put in different amounts, what you plan to kind of invest in your own terms, what kind of interest rate you can get. Now, usually if you just do the S&P 500, you can get 10% of interest. That is very important as well. And see what happens after 20 years, after 5 years, after however long your horizon is, so you can make some sort of a plan. Obviously, the more interest that you can get and the earlier that you can start is actually more important than how much money you're going to put in. So play around with that and see what you figure out for yourself. Kind of helps you to plan for yourself. Okay, so back to investments. So what else do you need to understand about markets? Well, they are cyclical. So there are periods where what we call a bull market is when the market is going up and everybody's making money. And then there are bear markets when things are going down and everybody's losing money. So recessions or stuff going on in the economy. So the market moves like this. Boom, 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 up, down, up, down, up, down, up, down. But the general trend of that movement is slightly to the up. So up, down, like this, but it keeps going up even though. So what you need to be doing is not to get caught up in those up and down movements. So those are irrelevant for long-term investors. What you are, as an investor, you're buying regularly and you don't care how much it costs. You only care about your investment horizon and how much money you're going to have at the end of that period. So the risk is getting caught up in that up and down motion. For example, in 2008, we know that was a big down motion in the markets, the Great Recession, during the 2020 epidemic as well, went down 34%. Scary time for a lot of people. When it goes down, people usually start panicking. Oh my God, I'm losing my savings. They might start selling off their portfolio, which would be a huge mistake because markets always recover. But it's very difficult to think about a potential recovery when you are, let's say, being crushed or war is going on or there's a pandemic or whatever is going on in the world. Everyone's thinking, oh my God, the world is going to end. I'm going to lose all my money. It's important to not get caught up into that as a long-term investor. Now, since the beginning of the existence of the stock market, depending on which kind of index you are looking at. And an index is basically a representation of the growth of the whole market. So you're kind of looking at, so the index kind of looks at the performance of the whole market. And usually it's between 5 and 7% average per year. Obviously, there could be some years that are minus 20, some are plus 30, others are minus 50, minus 3, plus 5. It's all over the place year by year. But on average, you have plus 5 to 7% yearly. And if you're looking at the S&P 500, which is currently the most popular index, that has averaged above 10% yearly. And just to mention, the S&P 500 is an index fund which represents 500 of the biggest companies in the US, basically represents the whole of the US market, and that usually is the market that grows the most. So people are from all over the world are investing in US stocks and buying the index fund S&P 500 in order to grow their own savings and to improve their financial position. Average returns is the thing that you need to focus on and the thing that you understand. So no matter what the market is doing year by year, your focus is on the statistics that prove average returns 5 to 7% or 10% for the S&P 500 is there, and that's what you need to be aiming for. That's what you need to be planning for when you're doing your portfolio, which we will take a look at in the second video. There are many types of investments that you can be buying. There are bonds, there's gold, there is commodities, which is oil and metals. There is stocks, there is ETFs, exchange traded funds, there is hedge funds, mutual funds, all these different types of investment products. But my recommendation is just keep it simple. Do not go all in buying all these different types of products. Just buy a simple index fund like the S&P 500, set and forget, and keep buying that, and that's it. Because what my market experience has shown me is that the more complexity that you have in your portfolio, the more likely you are to not understand or not fully understand one of those products, and the more likely you are to make a mistake or lose some money somewhere. So the S&P 500 is very diversified, and what diversified means is because you do not own a single piece of stock or a single company, you own 500 companies, a basket of 500 companies. There is pretty much no chance that your investment will go to zero, unless obviously some massive catastrophe happens and just the world is gone and our whole economic system collapses, which is very, very unlikely because that would mean the apocalypse. And in the apocalypse, you don't need money anyway. You're going to need food, shelter, guns, or whatever. So as a beginner investor, the most important thing for you is to, number one, keep it very simple. Keep it diversified, and when you buy an ETF, it is already diversified, so you don't need to think about that. And you need to create a strategy which is set and forget. So you need to make it easy for yourself to follow into that strategy. So that's why I am recommending that you buy only one product, which is the S&P 500 index, and you keep buying that regularly. You don't try to be a stock market picker, or you don't try to outperform the market, because statistically the chances of that happening are very, very, very low. And so read the book by John C. Bogle if you can, because it explains very, very well the basics of index fund investing and why that is historically and statistically proven to be the best and safest and most diversified strategy, which regular people use, but also billionaires use. A lot of billionaires, a lot of people have huge amounts of money in S&P index funds because it is just the bread and butter of investing. And there is a reason for it to be that way, because it's just historically and statistically proven itself over the time that the S&P 500, that the market has even existed, that has proven itself to be the best bet. It is the absolute gold standard of investing, and that is why people like Warren Buffett and pretty much anywhere you would look, you would get recommendations for just put in the S&P 500 and forget it, and that's it. So again, to summarize, Markets are cyclical, they go up and down all the time. What you need to be focusing is on average returns rather than to be caught up in the up and down motion. Don't worry about bear bull markets. You're not a stock picker. Don't try to be picking stocks, because when you pick an individual stock, the chance that your investment goes to zero is much higher. Even if it's Apple, Google, whatever, there is much more risk involved into picking an individual stock compared to an index fund which is already diversified. Pick something simple, make it easy for yourself to follow, make it easy for yourself to build that habit. And those are kind of the things that you need to understand about the markets and the investment theory, investment basics. Now in the next video, like I said, we will be taking a look at what you need to kind of think about for yourself to make the decision, okay, how much am I going to invest? What is my long-term horizon? How many years? What kind of risk can I afford, etc., etc. Stay tuned for video number 2, and thank you for watching, and I'll see you next time.